So just to say, I'm Michaela Johns, one of the directors at HWB. I head up the Academy Schools team. And joining me today as speakers are Matt Cooper, who's Associate Director, and Alan Davies as Senior Audit Manager. And then right at the end, we will be running a sort of a panel session, and Alan Rolfe will then join us, who is our Senior Tax Manager as well. And I'll try and interview them all and give you opportunity to ask any questions. Some questions have come in advance and we've got those, but if there are any questions that you want to save to that point, then please put it to the panel and we'll give you our words of wisdom or at least an opinion on the topic, one way or the other. So let me take you through today's agenda. First of all, Alan will cover the main issues that arose out of last year's audit. Then Matt will cover some of the common issues that came up via the DFE summary, which is for the year before. Then we'll go back to Alan for benchmarking. We'll cover a few of the budget announcements, which will be Matt. I will pick up on the procurement and the charity SORP. And then we'll go back to Matt for some dates for your diaries, for timetable and maximising value for pupils. We'll then have the panel, as I mentioned. And then finally, we'll look at the dates for the forums for the rest of the year. So let's begin with Alan.
Thanks very much, Michaela, and good afternoon, everybody. Well, we've seen some welcome signs of spring in the last week, and last autumn's audit and accounts are becoming a bit of a distant memory. So before we forget about them completely, we just thought it would be useful just to have a recap of the main issues arising from the audits that we undertook last year. Now, there's always a lot going on in the academy world, but in terms at least of accounts and compliance, we're in a sort of relative period of stability with few changes to the accounts direction over the last few years, and similarly only minor changes to the handbook and some simplifications. So, for example, last year we saw the first year where the DFE's pre-approval of finance leases applied. That was helpful for Academy Trust and for us because it took away some of the issues that we'd experienced in previous years in relation to leases which cropped up as part of catering contracts and that kind of thing, which required pre-approval but were often overlooked because they weren't obviously leases. So that was very helpful. And on the whole, this little window of stability has allowed trusts to improve their compliance with the requirements. Last year we saw some recurring issues and some newer or less commonly seen points. But just to give an overview, in the main last year we were able to issue mostly clean, unqualified audit reports, both the financial statements and regularity. We did have a couple of issues that led to qualifications, so I'll just pick those up now. Firstly, on land and buildings, this was a point that we covered in quite a bit of detail this time last year, so I won't go into it in too much depth, but just to give a brief summary, we had a qualification arising from the requirement in the handbook to put the value of land and buildings onto the balance sheet. Can be seen as a bit odd if to anyone not familiar with the requirement, where the buildings are typically held under lease rather than owned, but the value on the balance sheet represents the right of use rather than the ownership. There's three ways of calculating that typically. There's the option to use an existing local authority valuation. There's the option to go out and commission a new valuation from a valuer or surveyor with the appropriate professional qualifications, or the DFE publish their own desktop valuations as well. There's not always existing local authority valuations in place, and of course the cost of commissioning new valuations is often seen as prohibitive, something to be avoided, where academy budgets are being squeezed. So quite often trusts default to using the DFE's valuation. but there can be a delay in receiving that for any new converters, and that was the case in the issue we had where the desktop valuation was not received on time. The Academy Trust had to omit those figures from its accounts, and we had to give a qualified opinion on the financial statements. Then next year, the current year that we're in, they'll bring those in as an adjustment to the prior year comparatives. And this is something we've seen a few times over the last 2 or 3 years. We're not really aware of any ramifications to this from the DFE, but our recommendation, I think, would be if you have a newly converted academy, liaise with the DFE at an early point just to make sure that any valuation report can be requested as soon as possible, just to make sure it's received in time for the accounts. The other qualification point we had was in relation to restructuring cost, and that's another area where the rules can be complicated, and that's particularly the case with severance payments. We had a regularity qualification in this area where the DFE rules were not met, so I thought it would just be useful just to briefly run through the requirements. The DFE class expenditure which goes beyond either statutory or contractual obligations as being a special payment. That can include staff severance or compensation, and I'll focus on staff severance payments. DFE require that academies look at 3 factors before making a staff severance payment. Firstly, is it in the trust's best interest to make that payment? Secondly, what is the likely outcome of any employment tribunal, which is in relation to that payment? What's the Academy's expected success in defending that tribunal? And then thirdly, what's the likely level of settlement? And they require that must be less than the likely award at any employment tribunal. That's a must that's in the handbook. And the DFE's aim here is to ensure that any of these payments are not seen as a reward for failure, like for poor performance or gross misconduct, and they require that any payment in these cases can only be made where a claimant is likely to succeed at tribunal. That might be, for example, due to admin errors in the HR process or something like that, or where the time and cost of any performance management or capability processes will be excessive. Where the Academy Trust is considering making a staff severance payment, DFE prior approval is required in any cases where that payment is going to be over £50,000, and that's a gross threshold, so prior to any deductions. And with our regularity qualification, the trust in question had made a settlement payment prior to obtaining the necessary approval. They had their reasons for that, but it meant that they could not comply with the requirement, and we had to qualify our regularity report. It's also worth noting that DFE prior approval is required for any staff severance payments where the total exit package, as it were, is going to exceed 100,000, where the salary of the person in question is over 174,000, where the agreement contains a confidentiality clause. That's something they're not keen on. And finally, hopefully it wouldn't apply, but where there's a financial notice to improve, they require prior approval as well. The DFE have published a guide to Academy Trust severance payments, so we recommend you have a look at that if it's relevant. So hopefully that's a useful summary of those requirements. We noted several issues in relation to internal scrutiny. Didn't lead us towards any qualifications, but we made some management letter points in our audit findings reports. Now, internal scrutiny is the process that the DFE require trusts to follow to provide effective oversight and monitoring of a trust's internal controls. And the aim is to provide assurance to the board that the trust has good controls in place and to help it improve its governance, risk and control arrangements. There's 4 ways that a trust can comply with the requirements. It can use an in-house internal auditor. That's prohibitively costly for all but the larger trusts. It can use a non-staff trustee if it's lucky to have such a person on the board that has the appropriate financial experience or professional qualifications. Not all do. There's the option to use a peer review by the CFO from another Academy trust. We have seen that before, but it's not something we see very often. Not quite sure why that is. And that typically leaves option 4, which is to have a bought-in internal audit service, which is where we see most trusts sit. The process needs to be driven by the Audit and Risk Committee, and in doing so, they must have reference to the Trust Risk Register to say what are the risky areas, where do we need to direct our internal scrutiny. And in directing it, it can cover financial and non-financial controls, although financial controls must be a core element of the process, so it can't just be non-financial, it's got to be financial as well. Non-financial areas can include things like IT systems, cybersecurity, health and safety, estates management, that kind of thing. And where we noted issues in this area, it tended to be where internal scrutiny either didn't take place for whatever reason, wasn't sufficient in terms of its depth or number of reviews during the year, or the subject matter was not in line with the risk register. And again, the DfE have published a good practice guide to internal scrutiny. So we recommend you have a look at that if you're not sure that your trust is compliant in that area. We noted some issues on procurement thresholds, particularly in relation to agency staffing, but we're going to cover that in a little more detail later on. So moving on to look at the local government pension scheme, this year we saw most trusts either remain in a surplus position or move into a surplus position. So that was almost universal across most of our clients that we acted for. Now, up to now, those surpluses haven't been recognised on the balance sheet because there's not been enough evidence that there's a recoverable asset. For example, no indication of any refunds or reduction in contributions. But now we're starting to see reductions in contributions come through from April this year. So I think that might change things a little bit in regard to do those assets get recognised on the balance sheet or not. So we're looking for guidance in this year's accounts direction. Hopefully we'll see something in there to give us a steer on whether or not those assets should be brought onto the balance sheet. And then finally this year we saw changes to the employment allowance rules, which meant that more Academy trusts could claim the £10,500 allowance. Previously we had a cap on employer national insurance contributions, which meant that only the most tiny of primary schools were likely to be able to claim this allowance. But that disappeared from April last year. So now all trusts can claim the allowance, but it's not something that was very widely publicised. So a lot of trusts missed out on claiming this allowance. So we brought that to their attention in our audit findings report. Particularly important given the increases in the employer's contribution rate and the fact that the funding that the DfE issued to cover that increase wasn't always sufficient in a lot of cases, so it just helped cushion the blow a little bit. So recommend that you check with your payroll provider or in-house specialist to ensure that your trust has claimed the allowance. And just a final point on that is that it's one allowance per multi-academy trust rather than one per academy. So I think now just moving on to the next slide, it was just to give you just a visual summary of the number of audit findings report comments that we're making, our management letter points, in comparison to previous years. And as you can see, after some significant reductions in the number of points raised in recent years, this sort of levelled off somewhat last year. The main areas that we were raising points, from a financial statement point of view, it was points in relation to fixed assets and accounting adjustments such as accrued income. So fixed assets can be quite a confusing area for a lot of Academy trusts. And I think in terms of our points that we're raising, a recommendation would really be to have a monthly process in place to check that the totals on the fixed asset register are in agreement to the balances on your trial balance. The fixed asset register is up to date for any new additions, and that depreciation has been calculated. We can do a health check on your fixed asset register if you'd like us to. If that's something that would be helpful, please get in contact and we can have a look. And similarly on fixed assets, we noted several points in relation to the classification of costs between expenditure and fixed asset additions, particularly where expenditure had been above the threshold that trusts set for capitalising it, putting it on the balance sheet, but had been left within expenditure. And our recommendation there is that you have a process in place monthly, for example, to go through your key expenditure headings, such as probably IT hardware, repairs and maintenance, to look at the larger figures in there. Is there anything that should be put onto the fixed asset register and moved to the balance sheet? And then on accrued income, I think this year probably the main complexity was that we had the National Insurance Contribution Grant. It was a grant that applied from April 25, but was actually only paid after the year end, I think in October or November. So a lot of trusts naturally missed out on bringing those 5 months onto the balance sheet as accrued income. So quite a lot of our points were in relation to that. Moving on to regularity, no surprise to us really that the website transparency requirements were generated most of the points that we were raising. It's a complicated area with frequent changes in trustees, local governors. It can be difficult to ensure that the trust website, the DFE website and Companies House are all aligned. And again, the Academy Trust Handbook has a myriad of other things that need to go on the website. So it's a very hard thing to keep track of. We ended up raising quite a number of points in this area. So to try and help you make sure that you're meeting all of those requirements, we prepared a summary of all of the required website disclosures from the Academy Trust Handbook, picking up things like the Companies House, any other requirements like the pay gap disclosure, payment practices reporting, that kind of thing, and try to have that on one summary for you. So we'll circulate that after the forum, and hopefully that will help with that area. So I hope that gives a useful summary of this year's issues.
The next point with regards to statutory qualifications on the audit reports. So again, like a 50% increase. So I know it's only 0.6, but still quite a large increase on last year. A bit like Alan mentioned on the LGPS, that's kind of one of the primary drivers of qualifications last year. And then secondly, with regards to land and buildings treatment. So similar to what we identified was what DFE identified at like a national level as well. So yeah, they're quite technical, they're not day-to-day bookkeeping points, but again, still preventable. And obviously, if any queries, then speak with your advisors. The next point with regards to regularity, so pretty much flat year on year. And again, most kind of common areas for qualifications were with regards to weak internal kind of financial reporting, so where management accounts are not being produced or kind of incomplete information being provided to the boards. And then also with regards to some related party transaction breaches. So again, it's those kind of areas which, quite like classic kind of finance basics really. So all kind of controllable risks to be looked into. The next one's EOMs, emphasis of matter and or material uncertainties. So essentially, majority of these were with regard to kind of like going concern risks. So can the trust continue for the foreseeable? So of that 13.4%, 8.3 was with regards to kind of trusts closing or transferring. But the large increase to 3.2% of that amount, which was almost a threefold increase on last year, was with regards to financial health concerns. So clearly the DfE is kind of seeing more pressure on financial sustainability, which then feeds into kind of the auditors' going concern reviews at the year end. Internal scrutiny. So again, similar to what Alan mentioned, it's one of the main kind of regularity points as well, where qualifications are seen or management letter points are raised. Common issue with there not being any in the first place. It's obviously quite an issue. But they're also seeing quite a wide variation in kind of quality. So we're trying to kind of move away from the point that it's essentially a tick box exercise, more onto really kind of a risk-based process where it kind of actually adds that value. Financial management and governance reviews, so 98% year on year. So again, kind of got a strong kind of pass rate, if you like. So of that 98%, that kind of covers all the fully compliant, the good, or the satisfactory. So, but of the ones where we did identify issues, again, the kind of key areas with regards to kind of audit and risk committees, quality and frequency of management accounts, oversight of risk registers, and then executive pay setting as well. So it's what we're kind of seeing is they're kind of just drilling more into the governance as well on that level. Moving on to the next one, to funding audits. So again, a really kind of high pass rate, if you like, so very low error rates, and that covers things like pre-16 funding, 16 to 19 and pupil premium. The errors they found in the pre-16 mainly related to kind of free school meals evidence. So again, it's just about like documentation and having that ready when required. And they expanded their review into early years funding on this latest review as well. And on that side of things, kind of the highest error rates would relate to incomplete attendance records and insufficient evidence of entitlement. So again, it really just kind of comes down to that evidence retention, just to make sure that even if you know you're doing the right thing, you've kind of documented it, you've written it down somewhere, so then you can evidence that upon when it's been asked for. In terms of the SRMSA, I think I said that right. Quite a good improvement on last year. There's still lower compliance than other returns, so still got a sub 90%. And again, kind of non-compliance issues there, mainly related to trustee awareness of health and safety duties, clarity of plans for use of reserves, and then kind of like confirming no outstanding audit issues. So again, kind of shows the importance of kind of taking on board points raised by internal or external auditors, kind of trying to get them cleared and obviously ask them questions if unsure. So just last on here, looking ahead to 25-26 and 26-27, just trying to see kind of what the DfE found as main areas and where they might be looking moving forwards. So clearly kind of financial sustainability and kind of going concern. So kind of an increased focus on financial health and cash flow resilience, especially where deficits persist or reserves are low or declining. So kind of having that focus on that area. Quality of management accounts and board reporting. So again, that was kind of the main area where they identified a lot of non-compliance with irregularity. So again, it's just having those processes in place, just making sure you kind of got those policies ready to complete that. And you've kind of also kind of evidencing the board challenge and the decision making behind it as well. And then internal scrutiny, a bit like I said, it's kind of moving away from done, tick, more to an effective program, which is really trying to help on those high risks which are identified by the Audit and Risk Committee. And then lastly, kind of like similar with regards to like financial resilience, but more on like the reserve side. So it's kind of having that strategy in place, having that financial planning in place. We've already kind of seen across some of our clients where the DfE are getting in touch essentially querying high level of reserves, kind of seeing what the trustees have in place to either kind of use it up, what their plans are, what their capital strategy is. So again, it's on the opposite side. If it's kind of getting below 5% or lower, it's kind of, what are the cost mitigation plans to try and obviously improve that position. So can't do right for doing wrong as a tacking high, tacking low, say, in that sweet spot somewhere. So yeah, kind of closing line here really is quite kind of high compliance in terms of a lot of the returns which are completed throughout the year. But again, it's just those kind of main areas around kind of internal scrutiny, management reporting, financial resilience, just to, again, keep focus on. And obviously, if any questions, just reach out to us or your auditors, really, particularly around closures where you've still got that filing requirement.
Benchmarking. We use information from our accounts returns to produce a free of charge benchmarking report for all of our academies, and we issued our reports this year at the end of January. And our ethos in doing that is really consistency, I suppose, and also it's been to keep the report to a relatively small number of key performance indicators and to make sure that those are consistent from one year to another and comparable between trusts. Looking at some statistics can be misleading, such as costs that can vary from trust to trust in terms of how they're recorded, things that can be outsourced or in-house, like cleaning or catering, and things that are classified in different ways between academy trusts. So we aim to ensure that our reports can be comparable, and we aim to keep them consistent so that this year's report can be easily compared against last year's to see where things have moved. We also aim to keep them timely, so we issue ours as soon as possible so that they can be used promptly while the information is up to date. In our reports, we also include a summary of the audit findings report benchmarking, just to give an indication of how the audit findings report number of comments compares to the average for primary or secondary, just to give a bit more context to our report, just to show how it compares to the average. We've prepared a short summary of this year's key figures, which will circulate after the forum, but just to give you a few highlights from this year's edition. I think this year's figures really reflect the effect of increased staffing costs in the sector, following pay awards and increases in employers' national insurance and pension contributions. Consequently, we've seen the average amount of expenditure within academy trusts as a per pupil KPI increase quite dramatically this year compared to last. And staffing costs in particular, as a percentage of total costs, have also increased slightly, now accounting for, in the main, 4/5 of all expenditure. As I mentioned earlier, while specific funding was provided by the DfE to cover these sort of increases, it didn't always cover the actual amount of cost increase, particularly in the case of the salary increase. So academies have had to adopt other measures to ensure that they can balance their budgets. Last year we saw an increase in the amount of income academies were obtaining from investments, as trusts obtained better returns on surplus funds that they were holding, for example, through the use of investment platforms. We also saw reductions in some categories for expenditure. For example, premises costs was an area where we saw the per pupil expenditure come down slightly this year compared to last. And just on the subject of investment returns, the DfE launched a banking comparison tool recently to help trusts increase their returns from investments. Might be worth having a look at that to see if you could increase your investment income, for example, with a savings account from your own or a different bank, or the use of a cash management platforms such as Insignis or Flagstone to increase returns. And we've put the web link on the screen there if you want to have a look at that, to use that tool. I know some of you have used it successfully to improve investment income. While the overall financial position of Academy Trusts remained quite healthy, the majority managed to return in-year surpluses. That position is not quite so clear when you take into account contributions towards capital projects. So once those figures were included, we saw less than half of our secondary schools and only just over half of primaries managed to make a surplus in the year. And I think that highlights really the importance of long-term held as a percentage of total income, excluding anything to do with capital, just reduced by 1 percentage point at both primary and secondary levels. So we can see there's just being a bit of a squeeze on reserves. And finally, on benchmarking, it's just interesting to see how many trusts are adopting the DfE's Chart of Accounts. And whereas we saw quite a good take-up on that in previous years, we saw that very much level last year, with very few additional trusts adopting that Chart of Accounts. I think Academy Trusts have got their own reasons for sticking to the chart that they used to, but it does help with consistently populating returns such as the accounts return and the budget forecast return, and it helps in respect of ensuring consistency between trusts with that regard. So if you're considering a change, for example, a change of accounting software, it might just be worth looking at adopting that new chart at the same time. So I hope that gives a useful summary.
Budget announcements, obviously not a massive amount, which I'm sure you mainly agree on. Firstly, I mean, SEND kind of funding reforms. So kind of a major structural change to SEND funding, essentially kind of moving SEND deficits from the local authority to central government by April 28. Well, that's the plan anyway. They estimate that's going to have a £6.3 billion cost throughout 28-29. And then the OBR kind of mentioned that, obviously, if that were to come within the core schools budget, so mainstream per pupil funding could fall by 1.7% as opposed to 2.4% increase. So clearly some work to do by the government to figure that one out in the next couple of years. They are expecting kind of centralisation to kind of improve some consistency, but obviously could come with pressure to reduce long-term SEND spending in the long term. A couple of ones kind of linked to books. So secondary school books wise, so they pledged 5 million for secondary schools, to averages out about £1,400 per school for new library books, and that comes on a previous pledge of 10 million for primary schools to all have a library by 2029. So again, kind of going down the line a little bit, I think they mentioned 1,700 primaries kind of without one, so trying to have that funding in there to achieve that as part of their kind of plan to make 2026 the year of reading. The next one was a bit ambiguous, and I'm not sure if anyone's kind of seen anything more with regards to playgrounds. So yeah, £18 million pledged, but I wasn't sure. Well, it was unclear if it applies to just school playgrounds or public spaces or both. So again, it might be a little bit more devil in the detail on that one to see where that funding is going to end up. No new capital allocations, kind of in addition to what's already been allocated and confirmed, despite estate pressures, which I'm going to touch on the next slide as well. So kind of, overall, nothing particularly exciting to write home about. And no kind of increases in terms of revenue income either, kind of mentioned in last year's budget. The year spending review sets out plans to raise the budget from 64.8 billion this year to 69.5 in 2028, which is a 4.7 billion in terms of cash increase, but obviously chipping away at that inflation each year. So probably, more room to go in terms of trying to balance the books there. Obviously going back on the previous slide I mentioned in terms of the financial sustainability. So it's kind of, here there's a growing picture where there'll be more funding is required. Next slide, please. So as I mentioned, so this next one, good drink. A couple of weeks ago, the DfE published a document they called Education Estate Strategy, A Decade of National Renewal. So at just a short 48 pages, it's a lovely little bedtime read for anyone interested. So they they essentially slated the previous government about how it's all fallen down below, as they usually do, and how their new magical 10-year plan is going to fix everything. But as a kind of general overview, I mentioned it's going to be their 10-year national strategy to fix and renew. It covers all kind of 22,000 plus schools and colleges across England, covering over 10 million kind of kids and adult learners as well. It's intending for it to shift from a patch and mend mentality to kind of proactive strategic estate management. And we mentioned how obviously it's kind of the sector's kind of suffered from years of underinvestment, short-term funding cycles and reactive maintenance. So again, painting the picture, obviously to try and make them seem rosy. They've focused on 4 areas, all beginning with S, so safe, suitable, sustainable and sufficiently sized. And they've mentioned that's backed by 38 billion of capital funding between now and 2030, along with more certainty by 34-35, so 10 years. Obviously we'll see what happens kind of at the next general election in terms of how this goes, kind of looking that far in advance. So the next point, so again, just kind of a few main areas really just to quickly go through. So we're trying to focus on professionalising estate management, so kind of clear expectations on responsible bodies, so kind of board of trustees, just trying to move away from estate management kind of being just simply about compliance and reacting to kind of moving into a place where kind of trusts have asset management plans, reliable data, and a real focus and kind of strategic plan on where the good points are to look at that. At some point this month, so only a few days left, they're going to be launching a Manage Your Education Estate digital service.
This
morning
it came out. Yeah,
I looked yesterday. Too slow. There we go. So that's been announced. And then from autumn 2026, so just to add to your workloads, there's going to be a new return to complete. We're currently calling it the Light Touch Estate Management Return. So look, DfE essentially trying to target kind of support to schools that are not meeting the DfE school estate management standards. It all kind of comes in line with the previous estate management standards, which was released recently. Moving on to kind of data and digital. So again, kind of more in line with, again, the focus on kind of the IT standards by 2030. So they're trying to just crack down on the fact that obviously kind of estates data are seen as a critical enabler of better decision making. So like with other areas like the LBCT that were brought in a few years ago, they're hoping that this extra data will then allow them to kind of make more timely decisions and kind of provide targeted support as opposed to kind of the previous kind of SIF applications and bids, which I'm sure you've all enjoyed at one point or another. So they're going to release data standards and digital structures in April, and then hoping to have two-way data sharing between yourselves and the DfE by 2028. So again, it's all in the horizon. So like I said, what they're hoping is that will kind of lead to reduced bidding and duplication. So hopefully see kind of reduction in wasted time spent on SIF bids, where they'll already be able to see where the key areas are and kind of have that targeted support and funding. The next point with regards to improving and renewing existing buildings. So they mentioned trying to get a strong shift away from kind of reactive repairs. So again, it ties in with the fact that you're having kind of those estate strategy, having that in place, and focus on long-term maintenance and renewal. As I mentioned, capital maintenance funding confirmed through to 35 for that 10-year plan. And again, in April, they're going to issue a renewal and retrofit program. In April this year again. So lots of things are state-based in the pipeline, and that's going to provide further information with regards to kind of condition, climate resilience, energy efficiency, and value for money. So more areas on kind of improving and renewing existing as opposed to building from scratch. And then the next point is relating to kind of SE&D again. So they kind of see estate as a key enabler of inclusion across the board. And what they've mentioned is kind of from their research, they said that kind of physical environment plays a real role in outcomes for pupils of SEND, kind of including sensory regulation to attendance and well-being. So they've ring-fenced 3.7 billion of high needs capital funding over the next 5 years to kind of fund inclusion bases, sensory needs, accessibility, those sorts of areas. So again, just to try and see kind of what we see this as moving forward into 26, 27. So estates becoming kind of a board level strategic issue, kind of away from operational. So that clear line of sight between estate strategy, financial strategy, reserve strategy, all trying to bring it all in line with each other. As I mentioned, that new accountability and estate management standards with the new annual confirmation return coming in the autumn. Obviously, once they kind of issue guidance and kind of make that return live, we'll have a look through and issue that bit more guidance on that area. Hoping that better data equals better funding access. So like I mentioned, it's kind of having that consistent, reliable data, which they're going to release in April, and moving kind of away from patch and mend to that planned renewal. So just trying to essentially treat estate like any other major asset, because it is a major asset of schools. So just really trying to kind of maximise the potential from that.
So we thought we'd touch on the public sector procurement limits. These limits change every 2 years, and they changed on the 1st of January this year. And surprisingly, they either stayed the same or went down, which is quite odd given the inflation environment we're in. We can only assume that it's because the DfE wants tighter controls on spending and value for money. That's the assumption that we've come to. So we've covered this topic quite extensively in previous forums, and we've had external speakers in, Lorraine from Minerva, who sort of summarised all the key points for us. And that's really who we would recommend you go and speak to if you have any procurement issues in this area. It is a very specialist area, and we only sort of touch on it from the sort of audit perspective. But just a quick recap, the new 2023 Act came into force on the 24th of February 25, so in the last financial year. So it's almost been in place now for a year, and so your processes and procedures around procuring should now be embedded, or you might be testing them for the first time. So with no inflation in this area coming into the limits, I think we're going to see more and more issues in academy trusts. So it's really important that you try and have processes in place to ensure that you deal with the purchasing in line with these rules and the limits. So the table that I've put up there, I've set out the limits that were there at January 24 on the right hand side, and in the middle January 26. And as you can see, the top one went down and the middle one stayed the same and the bottom one went down. So I thought I'd just try and sort of bring this to life for you. So the bottom one is all around about building projects, really. And so, for example, we might have seen a new build project start at 5 million, which would have been fine. It would be under the limit. But then due to something unforeseen, that has now been extended to 5.5 million. And that's when the warning bells need to start to be rung, because you then need to go into a different process. So it's watching out for those sort of extensions, those add-ons that happen that then can cause you to have to follow these rules. The other area we see quite commonly is the middle one, the light touch regime, which is around catering. So you might come to the end of your catering contract and not had time to go out for a full procurement. So you might then decide just to extend it for 1 year. That can cause you to breach these rules as well. It's the whole life of the contract, not just the original. It's the whole life you need to look at. So all these little rules that are in there are there really and to trip you up. They do trip you up. We see it quite often. And then the most common one we see is the top one is around multi-academy trusts and the use of agency staff. Very hard to comply within this in a large multi-academy trust, and particularly with the limits decreasing. I know year on year we talk about this with many of our trusts, and we've mentioned it to local government and the DfE about increasing these limits around agency staff usage. It seems to be falling on deaf ears. So it's one that you just need to try to manage, but is often a breach for many multi-academy trusts. So just to say, there are DfE knowledge drop-in training sessions in this area that you can attend via webinars, and we recommend that anybody who is dealing with procurement in your teams should attend some of those to make sure their knowledge is up to date. Yep.
Can I just ask where cleaning contracts come in?
Cleaning come into the I can't remember now. Services and supplies, I believe. Yeah, catering's in the light touch. Yeah. As you can see, on any school of any size, it's quite easy to go over these limits very, very quickly.
So how does that work? You've got a cleaning contract then that you've had for a year that's under the supply and services, but you might be looking then to renew them for another year.
So it depends what the original contract said. If the contract was 1 year and you're below that, that's fine. You're fine. If you go back to for another year, you're still below. But if you extend it without going, without looking at that limit,
Okay.
yeah, you need to be careful. Otherwise, it adds up. If you've got an extension in there, you've got to look at the whole period. Yeah. Okay, as I said, quite a complex area, but just hopefully that's given you an update on the limits.
I've got another question. So here's one that kind of had a conversation a bit before. We're finding that we're using a lot of external bespoke SEN that is being governed to us by Hampshire. So they are saying you need to send this child here and we're all paying for that. Technically, we're paying the invoices, but we're not doing the procuring. How do we sit on that for certain companies like Delta and things like that, where you can quite easily get to over 173?
I'd imagine they're on the framework if Hampshire have said to you, use this. And therefore, if they're on the approved framework, you ought to check it though, because it's your responsibility to check they're on the framework, and therefore they will come outside of that agency rules. Yeah. Okay, moving on to the charity statement of recommended practice. So this came out in October 25, and so it is applicable to Academy Trusts because even though you are exempt charities, you are a charity. So you have to still comply with this legislation. The first year that it will affect you and your accounts is August 27, so you've got 1 more year of no change. And we're sort of waiting to see how the Academy Accounts Direction and the handbook link this up with their guidance as well. And in particular, there's been some changes around the Financial Reporting Standard 102 on leases, and this is where leases now would need to go onto the balance sheet and be treated like a fixed asset. And this may affect academy schools that are diocese driven, because at the moment a lot of the diocese schools have a 2-year agreement, And the guidance, as we know it at the moment, is that the ICAW have told us that they don't think that these will need to be brought onto your balance sheet, but we're waiting to see what the DFE say, because there's this sort of principle in accounting of sort of substance over legal form, and so we're trying to get a bit more guidance. But as I said, we've got a little bit of time, so we'll once we know definitely what comes out in this year's updates, we'll let you know. It mainly affects diocesan schools. A lot of the rest of your schools, I don't think, have a lot of land and buildings that you lease. You have the agreement already with the local authority to use over a long leasehold or a freehold basis. Other things that have changed are around the trustee report requirements. And for most of you as Academy Trusts, you will now be deemed as Tier 2 or Tier 3 as a charity, and therefore require to have a couple of paragraphs in your trustees report around sustainability and impact reporting. Most of you have that in there already. It's just not been highlighted as a separate heading, so I think it's about just rearranging your reports slightly, and again will depend on the size of your trust. So tier 1 who don't have to comply are less than 500,000 income. I don't think that affects anybody in the room. Between 500,000 income and 15 million, you're Tier 2 and have to do a certain level of reporting, and then at above 15 million income you have to do more reporting. So you might need to sort of have a look at that if you're above that 15 million, and make sure you've got gathering the information in anticipation of making those disclosures that will be needed. In addition, there's a consultation out at the moment on audit limits for charities, which is due to end at September this year. And the thinking at the moment is if your income levels are less than 1.5 million, you may not need an audit. Again, that was only likely to affect some single academy primary trusts. But again, waiting to see what the DFE say about academies, because that might well be overruled in the Academy Forum as well. Other changes that have happened in the charity world are around the Charity Governance Code. That was updated on the 3rd of November. And again, it's all about good practice. And I'd recommend, if you haven't already, to circulate that summary of that Charity Governance Code to your Board of Trustees to get them to have a read through and make sure that they feel that they're dealing with everything in a good practice way. And the same with the Code of Fundraising Practices, which again was issued back in November. Again, doesn't affect you hugely because you're not sort of out there shaking the tins, asking for money from general public, but you are still subject to that fundraising practices. And as you know, you've got a paragraph in your trustees report about that. And then the big thing that's coming in, Employment Rights Bill, which obviously has got lots of changes that come into place from April. And obviously, with it being one of your largest costs, your employees, very important to get it right. Make sure that your HR support, be it internal or external, is advising you of the changes. And with that in mind, we have actually got a speaker on this at the next forum, just to give you some highlights about what they see affecting the academy school sector.
Yep, so obviously everyone's going to be pretty much aware of these as a year on year, but just quickly to run through. So in a couple of weeks, we've got the SRMSA tool to be submitted on the 13th. It went live on 26th of January, so hopefully that's all in place, ready to go. The next one with regards to the financial statement submission to Companies House. So we've got 9 months to file after the year end, so end of May. And correct if I'm wrong, Ellen, but I believe they're predominantly done already.
Yes.
Yeah. So,
but just to make sure they're on the website by that date as well.
Next one, we've got the TPS end of year certificate. So the last working day of May. So essentially to upload to the employer portal, as you know, like details of contribution splits, those sorts of things. once that's submitted, if again you could send that to your auditors, and if that's us, then over to Alan again, ready for us to complete the audits on those. And then we've got until the last working day in September to get those all filed and submitted to the TPS. The next one is the budget forecast return. So we've estimated the 28th of August, so probably the last working day in August, to get that submitted with the obviously the forecast results on there. And again, I believe Alan's going to be touching on some of those potential forecast of costs shortly towards the end. Next one we've got is BLBCT. So again, they tend to release their guidance in the autumn each year, so October, November time. So again, once that comes out, have a look through, see what's required. It will likely, obviously, it'll all be pre-populated from before, so just really to review and check for any changes or anything new this year. We've estimated 16th of December, tends to be mid-December somewhere, so again, around that sort of date. Comes around pretty quick, so then we've got the financial statements again by the end of the year. So along with the internal scrutiny report, so again, have that in hand and written up, ready to send to your auditors. And then, like Alan mentioned, following that in Jan 27, we'll have the accounts on the website for next year as well. It feels like we've only just completed it, but by Jan 27, we'll then have the accounts return as well. So again, just ready for your diaries. And then one more, which isn't on there, but I mentioned earlier, is the new kind of estates management return, which will be due in the autumn at some point. So once that guidance is released, obviously we'll circulate that round in our e-news, just to make sure everyone's aware. So yeah, obviously nothing new apart from that estates management return, but just for awareness, really.
And sorry, could you just clarify the dates on which accounts need to be on your website?
So that's the 31st of January.
That is the 31st.
Yep.
Yep. Thanks.
Lovely. Okay, so last one from me. So yeah, maximising value for pupils. So this was, again, some additional guidance published in December last year, I believe on the 3rd. So I think over the last year or two, quite a lot of kind of new initiatives have been trying to, or have been released. So this, in a way, seemed like they're trying to just put them all together under kind of one bit of guidance, which covers all sorts of areas. So what they've stated, so the DfE's message is every pound should deliver maximum impact for pupils, and the DfE wants to remove system-wide barriers that don't push up costs. They said it's not a cutting corners agenda, it's about smarter deployment, better buying, stronger planning, all of those stuff which DfE mentions. So in terms of kind of support for schools and trusts, it said they're going to try and equip trust with data and insights. So again, it comes back to that kind of data analysis and input point from earlier. Obviously, we're still trying to encourage the use of their FBIT, so their financial benchmarking and insights tool, to compare against other similar schools and trusts to identify kind of the big potential saving opportunities. So again, it kind of comes back to benchmarking, like Anna mentioned earlier, in terms of just kind of see where potential improvements could be made at your own trusts or any cost-cutting areas. They put it into 4 pillars, so I'm just going to quickly run through those. So the first one was with regards to kind of commerciality, really. So what they're essentially saying is, with over 22,000 schools trying to harness kind of the buying power of that sector. The first area, it's around kind of 20% is non-staff costs, and the DfE believes that kind of more value can be achieved in that area. They mentioned that one of their recent energy pilot schemes, participating schools save on average 36%. So if that's true, hopefully there's kind of areas where money can be saved. The main areas they're going to be focusing on to begin with, relating to kind of management information systems, technology, learning resources, and as Michaela touched on, agency supply as well. And they're going to be releasing a new rates cap for agency supply in June 26, later this year as well. So then once that's released and we've had a read through, we'll send around our updates. The second pillar was with regards to assets. So kind of in line with what I was mentioning earlier on the estates plan, trying to unlock that value kind of from the assets in place. They highlighted that in 23-24 there's just over kind of 6 billion kind of sat in reserves, essentially kind of excess cash. So as Alan mentioned, that kind of new tool, and we've going to be banging with John for the last couple of years, trying to earn money for money, essentially. So where kind of do have legitimate surplus cash, it's kind of trying to put that away into high interest accounts. So again, that was just for DFE, summarising that and trying to emphasise that. The third pillar relates to workforce. So again, we're kind of the remaining 80% of the cost base. So again, kind of focusing on deployment, not just simplistic cuts. They highlighted that kind of the national spend on agency was about 1.3 billion in 23-24, so vast amounts of money. So they're saying they're kind of going to crack down on unacceptable practices, kind of any excessive supplier margins, essentially, with the support from the Crown Commercial Framework. So again, further practical support, including a kind of a toolkit, should be released at some point this year. So quite a lot of new changes coming up this year to get to grips with. And then the last one with regards to IT and digital. So again, back on the train of 2030 digitalisation. We kind of see it as like an enabler across the board in terms of trying to kind of put all these pillars in place and trying to find those efficiencies. Some kind of support mechanisms they've mentioned with regards to like training, qualification bursaries, mentoring, peer advisors, all of those sorts of things where kind of IT and digital can assist in that regard. And one stat they put in there was on their 2025 technology in school survey, it says 31% of leaders said tech contributed to cost savings to some extent. So hopefully that some extent is more than negligible. So yeah, that's kind of that in that case. It's not as long as the previous document, so a quick read through shouldn't be too much of an issue.
Okay, well, we're going to move now to panel. So I'm going to bring Alan Rolfe up, and I shall try and keep these questions and answers short so that we can get through quite a few if we can. Take a seat, Alan. So thank you to those that sent in questions in advance. I'm going to cover those first, and then I'll come to the floor for any more questions. So we had a question in from Contoni around changing government policy around in regard to academies. So Matt's going to comment on that first, and others will chip in. So thoughts, mate?
Yeah. So I think, like I mentioned earlier on the budget notes, that's nothing kind of tantalising in terms of that. But I think in terms of kind of government changes overall, since Labour came in, I think there's quite a bit of uncertainty, a bit of potentially scaremongering. Lots of friends in place to make changes, but it's all gone a little bit quiet. In my opinion, I think where they call it had all these grand plans and kind of different manifestos on their gain rates, and then they kind of uncovered what they had to deal with, probably got a little bit scared maybe, and so it's slowing down. But I think, like I've highlighted a few bits earlier, there are plans in place quite a lot this year to kind of start getting things out.
So they did seem to attack the independent school sector, and they obviously put VAT on that, didn't they, Alan? Quite early on. But nothing in the academies sector?
No, I mean, VAT is always something that gets tinkered with when they want to raise money. But it seems like they decided to attack the independent schools with the VAT charge there. That's supposedly raising quite a lot of money. I don't think it's raising perhaps as much as they thought, but we're not seeing any hints that they're going to tweak the academy rules. It feels like that's still quite stable.
And any thinking about the local authorities would get that?
Yeah, I think that there's a bit of a theme of kind of like reduction of traditional academy freedoms. So the Children's and Wellbeing Schools Bill had Lord's amendments a couple of weeks ago, bit of a kind of a move away from kind of previous government's drive for academisation. There's a couple of bits which he changed for kind of upcoming. So from academies required to follow national curriculum, statutory pay and for additions. So where kind of things initially were a bit more local authority based, and this one is kind of getting a bit more back in that direction. And a couple of other bits. So kind of more duties on academies and local authorities to talk to each other as incorporate, and local authorities having more direction in admitting pupils, which academies, which were 30 before, is limited to make KE scores. So a bit more canal back to the BLM.
Okay. We had a question from Hilary around budget predictions. So pass that over. Yeah, to the both hands.
Yeah. I mean, if I just briefly mention that next Tuesday we've got the spring statement, which the government tots up its numbers and discovers how big the black hole is or isn't. I think before they were banging on the drum a lot about a 20 billion black hole that then when they added it up, they didn't find was there. So maybe the figures this time around might be a little bit better. But everything we've seen so far hasn't indicated they're willing to open the purse and pass money on. The recent consultation on SEND provision sounded very generous, but when you realize it's actually a long time in the future and when you divide it out between the schools, we're talking very low numbers. So we're not seeing any great generosity, and it'll be interesting to see what they say in the spring statement as to where they see their position, but I'm not expecting anything changes or any generous funding to be offered. We seem to see a lot of things that are pushed a long way into the distance, and that seems to be the pattern now. I guess on the VAT side, we haven't really seen any changes in terms of the registration threshold was widely tipped to reduce. That hasn't happened. I'm not expecting them to announce any changes on that. So, I think they just watch this space, but don't be surprised if it's a bit of a non-event on Tuesday.
We had another question from Rachel around assumptions for the 3-year pay increases. Any nuggets of wisdom learned?
I think we're probably sort of slightly early to make any sort of concrete, give any concrete advice really, but sort of taking the main elements, teachers' pay, taken slightly different there, whereas last year we had 4% increase from September, of which 3% is funded. The recommendation from the government at this point is that that actually making a sort of 3-year recommendation, that's going to be a 6.5% increase over the next 3 years. And whilst that's just their recommendation to the consulting body that actually comes up with more of the concrete recommendation, it gives an indication of where their sort of thoughts lie from how much they can afford. And with that 6.5%, not really much surprise to hear that, and it's going to be sort of more end-loaded rather than even. So you're kind of looking at percentage increases in the first couple of years and higher in year 3. So that's teachers. Support staff, I think was sort of slightly earlier in the process, whereas last year we had a sort of frequent 2% increase on all of the pay points. And this year we're just at what the opinions as to recommending, and that's sort of £3,000 is an absolute increase at each of the pay points. But from a percentage point of view, that comes out as very high. That's sort of on the lower end of the scale. That'd be like 12% increase year on year. So it's looking a lot higher than the 4% we had last year. So I think that's going to be quite a lot of compromising to be done there. So I think that's sort of a lot earlier in the process and not really no real indications. And looking at other costs, we're seeing, like I mentioned earlier, possibly some reductions in the employer's contribution for the local government pension scheme. In Hampshire, we've seen that come down just slightly from 17.9, I think, to 17 from April this year. And then in other areas do sit with looking at a sort of 1% reduction per year, I think, for 3 years. So that's something that we can look to build into all budget setting that we know about for sure now. And other costs, little inflation, currently we're at 3% with projections there. Look that it may be coming down more towards the target of 2%. So I think 2 to 3% is going to be a realistic figure to use to the minimum staff costs.
Do you have any other questions for the floor? Okay, so you keep a good song on the spot. If not, then I'm just going to ask each on the panel to give me a top tip that people can take away from various different years.
So I think kind of, so I don't want to teach any of the subtitles, but as you going on the basis of one of that financial issues and a bit of the deficit budgets and stuff, it's kind of just that revenue maximization. Was really just trying to think outside the box in terms of other ways where you can just bring in, even if it's not an awful lot, just a bit more, just to try and aid the budget. So I think kind of Anna mentioned bank interest. We've mentioned that for a few years now, and they do base rates coming down, but it's still 3.75%, and some longer term kind of deposits can still give a reasonable amount of money. And hiring facilities, so kind of sports halls, pitches, studios, car parks, anything there potentially where something like could be earned. Teachers, parent teacher associations or PTAs, obviously more common in kind of school settings, but I've seen there are schools who are really good parent teacher associations out there, secondary schools as well. Gift aid, you've got training subsidiary, you can talk bring that gift aid up, and someone like Pin refers in the tax structure there. Wraparound childcare, catering, nutrition, so all these sorts of areas just to really try and maximize the potential there to obviously help balance the budgets.
Yeah, I mean, I'd carry on the same theme really of bringing the cash in. Matt's mentioned gift aid. Make sure you register. Make sure you're claiming it where you can. When you're asking for voluntary donations, don't forget to use that as an opportunity to claim gift aid on it. Try and make that your default idea that people would make a donation that's going to be gift aided. Think about those times where there are small bits of money that might be passing back to parents. Perhaps you've taken a deposit for lockers or something like that. Why not give them the opportunity to voluntarily gift aid it back to the school so that you don't have to pass the money back? You just take it into the bank and gift aid it. And so gift aid's a used area. Another thing in terms of cash flow might be to think about moving to VAT returns monthly rather than quarterly if you're not already doing that, because that will accelerate the point at which you're claiming back the VAT. And really just look at making sure you've got the calculations in place to fully maximize that VAT recovery. I think that's, always something to keep an eye on. Make sure you've fully thought about what's non-business expenditure that you can therefore recover in the VAT on.
No, sorry, can I just ask Fancy, something like a parental contribution towards a trip cost, can we ask for gift aid on that?
So the tricky thing with gift aid is you have to make sure that what's being received in return isn't essentially a payment. So for a school trip, for example, the pupil will be getting a valuable trip, so you probably can't gift aid it. But there may be an opportunity to cover, say, the base cost of the trip as not a donation, but to suggest to parents, we would, the cost of the trip will be £50, but if you wouldn't mind gifting an extra £10, we can treat that as a donation that will gift aid, and that will help, make the trip go a bit more smoothly and help the school. So you've got to watch those things.
Can I just add to that? That would make me feel deeply uncomfortable from a charging remissions perspective and DFE perception of what is happening. And for community, I think that it might be tax regulations. From the sector perspective, that would make me feel wildly uncomfortable to begin to think about taking into practice. And just imagine the pushback coming from that would be astounding.
What we see more often is still like an annual plea of, your child's been for school for 5 years. And, there's a annual plea for any donations. Here's a letter. It just goes out. It's separate from everything else.
I think that's a bit more fee the entire, isn't it? Yeah, trying to add it onto a trip, just make I see where Lex is coming from. Dude.
Yeah, and that's definitely something you'd have to be very careful of, because breaking that link between what you're providing and asking for money is fraught with difficulty.
I just wanted to make sure.
Okay, Alan, get one from you?
Yeah, I think from a sort of audit or compliance point of view, I know earlier I mentioned about website is such a complicated area with the school's website, company's house, the DFE one. I think where you raise such a lot of points in that area, my top tip would be just to make sure that that's something that you've got covered. I mentioned the checklist we had earlier. We'll send that note to HWB to help you. I think that can be quite a good thing, and if you can sort of suggest or trustees grow that into their monitoring, but you have a trustee who's well placed that can take that on and monitor the website on a regular basis, and have that as part of the trustee monitoring. That's quite good for them to do sometimes. Really, that's my another suggestion for you.
I'll just finish on a couple of top tips as well. One is around the apprenticeship levy. You're all paying it, I'm sure. So make sure you use that. That's sort of £15,000 towards training for some of your employees. So do try and use that if you can. And then the other single biggest thing that stops me, sleeping at night is cyber. That is still the biggest risk for having schools and for charities in general. So do make sure, you're very tight on that area. And look at any sort of outdated equipment as well, because that can falls cyber risks as well. So those are 2 top tips. Sorry, question?
Only around that. It might be slightly outside your area. List registers. Okay, I was talking to someone and they had a strategic list register and an operational list register. And is that normal? Just
Down to your choice. Okay, yes, fine. There's no thing from the auditors say one is better than that.
Right. I mean, operational obviously isn't much more. As it says, day to day. Yeah, we much more look at the strategic roles.
Operation might be a way of actually managing it and doing some late tasks and bringing those back.
The DFE's guidance on this practices doesn't state you have to have one or not one.
Yeah, that's what I was hoping.
Even if you were to just have like a column saying operational strategic, you could put it all into one and just differentiates those points.
Yeah, well, question. Whether this will help you, we used to have a financial and a non-financial, and you find that sometimes the risks would get headed. So we just have a Google Doc now, and we had different tabs. So because there's myself and the business manager, and we're responsible for different areas. So it's one shared document now, but at least I'm not duplicating the risks that are on the two, within the 2 different areas. So that's how we sort of managed it. But it was before it was done while he was responsible and where they got reported. But we put it all in. Okay. But I don't think there's any one that's just. No, this is more of a are you aware? So my HR manager yesterday went on a call with TPS, and apparently they're changing provider from Civica to a new provider in June. So they're warning people that there might be a bit of an issue transferring over. Should we be requesting member prints and things now for our pension audits? Because I'm just thinking, after April, if we get to June and we're asking and then we're going back, it was a bit, my HR was a bit in.
I mean, it's as you just mentioned, as far as I'm concerned, if they might have to belly up the audits with them, so then we should as far as I'm concerned. Well, nothing to do with us.
I just wondered when we do our audit Because we get, should we be just being a bit ahead of the game and asking you for member prints, and we can get them all now so we don't.
It's a really good idea. I think with the teachers' pensions guidance there, to us as auditors, staff, it always comes up very late in the day, and we don't have that sort of early notice of these kind of things. So I think that's something we'll have a look into.
Okay. Well, I hope today is giving you a sort of good update on rattling through things at a pace.
One worst.
What was that? Sorry. Go on.
I was just going to say, I'm really grateful for the benchmark on the report, so I appreciate those sort of value added extra that we get. But where we are multi-phase age of the stage trust, we tend to be grouped into one or the other categories. So, for example, infant, junior, secondary, but I'm in the secondary crew. It might just be useful for people that have those mixed settings to be able to have sight of the other, assuming that those benchmarks are slightly different, because I know that my infants and junior are quite similar but slightly different from secondary. And I know, for example, ISBL benchmarks tend to group it into primary phase or secondary phase as well, and add different metrics in that respect. So, whilst I wouldn't want loads of additional, but if you have got that phase behind the scenes, it might be helpful.
Sure, but that's up for you. Please request anything like that from us, and we'll try and help. All right, so I think most of you are aware that we have a newswire. So if you want to sign up for that, please go onto the website and send you sort of monthly updates of what's changed. Our next Academy Forum session is on the 21st June. It will be online, and then another one planned for the 17th of September. Again, they are available online to book now if you wish. Do also have a trustee update again on the 10th of September in the evening. That's usually a better time for trustees, so please do get them signed up for that as well if you like.
Okay, now. Yeah, which one are you doing the speaker for them? I'll put in it towards the day. Yeah.